The $10 billion Housing Australia Future Fund is the centrepiece to how the Albanese Labor government is addressing our housing crisis. But rather than being an ambitious or historic move forward in addressing our housing problems, the Housing Australia Future Fund, the HAFF, is actually making our housing crisis worse. When Labor introduced the HAFF, it came under sustained criticism, most notably from the Australian Greens. This criticism primarily was that the HAFF was just not ambitious enough given the current level of severity in housing unaffordability. The common response from Labor was that something was better than nothing. Indeed, after a number of additional initiatives and amendments, the Greens and Independents ended up voting in favour of the HAFF. But this entire conversation about whether it's good enough, whether we let the perfect be the enemy of the good, kind of gives the game away. The game's gone. Rather than being a conversation about what's good enough or what's the bare minimum, we must understand that the HAFF isn't just not good enough, but it's actively harmful. The HAFF is actively perpetuating Australia's housing crisis. There are two ways in which the HAFF actively makes the housing crisis worse. Firstly, the nature of how the fund is structured necessarily increases house prices through investments in financial institutions and property. This has made the HAFF one of Australia's biggest property investors. Secondly, the HAFF props up Australia's dysfunctional social housing industry, one which transfers public money, infrastructure, and assets to this network of private and parasitic investors, developers, and landlords. But before we get to that, we first have to understand how the Housing Australia Future Fund works. In November 2023, the government created the HAFF, giving it $10 billion. With this $10 billion, the HAFF invests it across the domestic and global economy, generating a return on their investments. These returns are then dispersed to private developers, investors, and landlords, who in exchange use that funding to build and manage low-income rental housing. Altogether, it is projected the HAFF is going to build 30,000 homes by 2028. Many have rightly pointed out that the HAFF won't build enough housing to match the growth in social housing waiting lists. Swollen Pickles has a series worth checking out on the HAFF and where it's blundered. But even in those videos, the framing's cooked. We're still operating under the idea that something is better than nothing, that the HAFF is something that's better than, well, doing nothing. In reality, the HAFF has actively worsened our housing crisis. In order for the Housing Australia Future Fund to make a single dollar, it invests in companies whose business model is dependent upon house prices increasing, housing becoming less affordable. Before a single home is built, the HAFF generates returns on its investments. It makes money from investing in the economy. In this respect, it operates similar to our superannuation funds. Therefore, like super, the HAFF doesn't invest in a vacuum. The performance of the Australian economy is predicated upon the price of housing continually going up. This is because 60% of bank lending is in residential mortgages. Banks are the biggest shares on the stock exchange and comprise 90% of the financial system. What ends up happening is that the banks will intentionally crowd out or disregard commercial loans in favour of residential loans. By expanding loans into housing, by creating more and more credit, our financial system becomes dependent upon property prices going up and up. This means that strong house price growth, in other words, housing becoming less and less affordable, underpins the profitability and viability of our most basic and fundamental financial institutions, and therefore underpins our economy. As demonstrated by Williams 2009, a greater ability for banks to create credit and lend out into the economy engenders a large structural increase in demand for housing assets. The HAFF's biggest and most lucrative investments are in financial institutions, thereby expanding the supply of credit. In the last financial year, the biggest assets held by the HAFF were either in banks, private equity, or asset managers. Essentially, a web of private financial institutions which directly profit from housing prices going up. For the HAFF's investments to pay off, obviously, the companies have to be performing well, which in this case means perpetually growing house prices and increasing unaffordability. As found by Giarozzi and Horney 2020, bank stock price rises necessarily causes increases in household and corporate lending. Now, while many of these investments are local to Australia, like CommBank, ANZ, Macquarie, PIMCO, First Sentier, a lot of them are also multinational investments like in BlackRock, Blackstone, Goldman Sachs, Bain Capital, etc. But of course, many of these multinational companies are themselves invested in Australian markets. For example, BlackRock is the biggest shareholder of CommBank. So by flooding equity markets in hundreds of millions in public money to the benefit of these private financial conglomerates, the HAFF necessarily requires housing to become more unaffordable in order to generate a return on its investments. On top of that, the HAFF also just invests directly into Australian real estate, investing $38 million in the last financial year into the Australian real estate market. To sum up, the entire model of the HAFF requires housing to be less and less affordable. If prices don't go up, the HAFF won't make returns on its investments and therefore won't be able to fund its existence nor the disbursements into social housing. As such, what looks like success for the HAFF is large and sustained increases in housing prices. Necessarily, the HAFF's existence worsens the housing crisis. But you may say that's all well and fine. This is amazing. We're redirecting the excesses of the private market into social objectives, into providing low-income housing for those who most need it. The issue is that the HAFF isn't able to meet the projected demand for social housing as it is. So by investing in markets which necessarily require housing to be more unaffordable, the HAFF has the real potential to drive more people to need social housing than units it will build. And that's even under the best case scenario. But even if we disregard that point, the HAFF puts money into Australia's social housing industry. In this video, we went over how this industry has privatized the profits and socialized the risks. The way it works is that a private company known as a community housing organization, or a CHO, will acquire upfront finance from private financial institutions and uses that upfront capital to invest in real estate. Then the CHO will manage the property as a rental below the market rate. If the CHO successfully applies for funding, the HAFF will provide payments to cover the gap between operation costs and rental income for the next 25 years. In effect, the HAFF is not only subsidizing the operations of the private company, but subsidizing their debt repayments to the private financier. This privatized model has created a lucrative social housing industry, which we can see as the industry has expanded but also tended to monopolize. As such, an increasingly smaller number of CHOs cashed up on private finance are able to bid up house prices and are essentially guaranteed not to fail with free public money propping up their operations. What's more is that the majority of growth in the community housing sector comes from public stock transfers, or in other words, giving over public land and public housing over to these private organizations. There is no guarantee that HAFF-funded CHOs hold onto their low-income rental housing either. As pointed out by Swollen Pickles in his video, Housing Australia themselves say that after the 25-year payment ends, it's completely up to the property owner as to whether or not they sell or retain the property.
But at the end of the term, it is up to the property owner to work out what to do with the property. The dwellings may be retained or they may be sold.
No equity, no land, no title, just a 25-year subsidy stream that expires, after which the provider owns a portfolio of appreciating properties that taxpayers effectively funded.
We already see this happen. Recently, a CHO, ironically called Housing First, is selling off its Oasis estate in South Melbourne, obviously threatening the security of the residents. If you live in the inner south, consider getting involved with the Renters and Housing Union. Get involved with Rahu. We're very active in the inner south. We've just elected a bunch of brand new delegates who are fantastic. They're doing an amazing job. We've been organizing the residents at the Oasis estate, but also other residents who live under social housing managed by Housing First. A lot of people ask me, what can we do to fix the housing crisis? It just seems so totalizing and depressing. How can we get out of this? And it'll be dishonest of me or anyone, frankly, to say that there is a step-by-step checklist that we can follow to, fix everything. There's a blueprint that we just need to look at and everything will be fine. What we can do though, what may be a step in the right direction, is to start local and start collective. Landlords need our rent to manage their properties, to pay off their mortgage, and if they're a community housing provider, to pay off their debts, to pay off their staff. As opposed to sticking it out by yourself, when we get together, when we unionize, that is when we can most effectively exercise this leverage. But until that point, the HAFF is just yet another investment vehicle which leverages our future on housing prices going up and up, on housing getting less and less affordable. The HAFF signifies or represents the institutionalization of the social housing industry, recognizing this parasitic, financialized yet lucrative industry as the major point of intervention of the government into the housing market. In talking about housing, we have to keep in mind the actual real conditions and dynamics at play. More money doesn't equal better outcomes. Particularly in our highly financialized and real estate dependent economy and very privatized social housing industry, we have to keep in mind the actual forces at play. We have to look beyond the nice PR approved words used by politicians. Hopefully this video explains that the Housing Australia Future Fund isn't just not good enough or a good start, but rather actively worsening our housing crisis. Calls to double the HAFF, for example, are really misguided and will end up just cooking the housing market further. As I said, the only viable path forward is to start local and start collective, and also to start outside of Parliament. We can't be begging political parties to do better without any kind of oomph behind it. The most ambitious and substantial social change historically has always been driven by working people getting together and exercising their collective leverage to force the powers that be to the negotiating table. The wealth that landlords, developers, and investors use to buy their way into accessing politicians, that wealth is derived from the labor power of the working class. It's derived from the rent extracted from their income. We therefore have the potential to threaten this system of domination, to bring it to its knees, but we can only do that in union. We can only hope to strike back in union.